All right, welcome back, everybody. Good afternoon. We're joined by Rajan Chopra from Chopra Coaching. He joined us last Friday, to talk about the markets, and he's our market trading coach. And he's going to join us today, and he's going to be talking about our trading process. And so, welcome, Rajan.
Thank you, Michael. As last week's webinar was focused on defining what trading is, today we're going to discuss and talk about the trading process. By trading process, I mean, what is our overall business trading plan? How do we go about markets and asset classes to trade for a living? So one of the key early decisions the trader has to make is to find out or define for him or herself is, what type of a trader are you? Are you a day trader? Are you a position trader? Are you a quant trader? Are you sort of a discretionary trader? You focus on any particular asset classes, any particular market segments? Are you a macro trader? So it's important to first know what kind of a trader are we, because that's going to help develop a plan as to how we approach the markets.
I think if you could, tell us more about what we should look for in a trading process.
Yeah, so it's like having a business plan. The business plan is about making a business out of trading. That is sort of the overall idea behind it. So let's ask ourselves first, after we define what kind of a trader we are, that is a natural risk-taking disposition. It would be very difficult for a day trader to become a longer-term position trader, because that goes against their natural state. They're in and out. Whereas it would be very difficult for a longer-term horizon position trader to become a day trader, where he's going about doing hundreds of trades in any given day. That's not his natural state. So it's important to know what kind of a trader are we, what fits our natural state the best. Once we define that, then we need to figure out, or hopefully we already figured out, what markets are we going to trade? What asset class are we going to trade? I mean, today the world is full of, whether it's commodities, even within commodities, there's so many different assets, so many different markets. If it's fixed income, there you can break down the fixed income universe into 100 different components. Whether it's interest rates, short-term rates, long-term rates, or whether it's corporate bonds, junk bonds, whether it's distressed debt or whatever. If it's equity markets, again, it's a whole big universe. You got the whole world out there, emerging markets, developed markets, large caps, small caps, micro caps, technology, different market segments, different industries. It's difficult to be a master of all markets, even though some traders do pretend to be or attempt to be. But we need to figure out what asset classes, what market niches, or what particular markets are we going to trade. Once we determine that, then we got to also figure out, within those asset classes and markets that we choose to trade, what instruments do we utilize for our trading activity? Is it just plain and simple stocks, equities? You buy stocks, you sell stocks? Or is it the equity market? Is it ETNs or ETFs or other derivatives? If it's futures, is it options? Similarly, in the commodities world, the fixed income world, the currency world, what instruments are we going to choose? Is it exchange traded instruments, which tend to be more liquid? Or is it some over-the-counter instruments that are offered by dealers and brokers and investment banks that we choose to trade? It's important to know what instruments fit our risk profile the best, how can we get the most bang for our buck, and where we can push our edge a little closer to trades that may be profitable for us. So defining the type of trader we are, defining which markets or asset classes we want to trade, and what instruments we're going to utilize for our trading activity are some of the basic tools that we utilize to build a platform around our trading business. You guys with me so far, or have I lost you already?
No, you're doing great.
Next comes the overall plan. Let's take a 30,000-foot view and say, okay, how are we going to go about finding good trade ideas? I think it's a very important question, and there are no easy answers. Some people are adept at doing their own research. Others rely on third-party research, be it fundamental, technical analysis, or whatever it may be. But how are we going to go about finding trade ideas? Or are we simply just going to throw darts at the market as we wake up in the morning and say, okay, I'm going to buy this or sell this, and hope that I make some money. If not, I'll get out of it, I'll do something else. Well, in trading as a business, hope is never a good plan. One needs to have a strategy. One needs to have a more robust plan than just throwing darts at the market or hope. So it's important to know, how are we going to go about finding good trades? An example that I would utilize from my past life as a trader was, I was a more top-down kind of a trader. So I began, when I was looking for trade ideas, I began with a 30,000-foot view of the world and say, all right, this is the world as I see it today. And this is how I see the world 3 months from now, 6 months from now, a year from now. And my world that I was talking about at that time was the world of interest rates, because that is the market that I chose to specialize in. That is the market that I knew a thing or two about. That is the market where I knew most of the instruments and the attributes of how the instruments traded, their behavior patterns. I also knew where the capital flows are coming from or going to, who the major traders were. So it was a universe that I was very familiar with. And those are the instruments, and that was the market I chose to trade. So I began the process of finding a trade idea by taking a real top-down approach and saying, okay, what does the world look like? Yeah, 6 months forward, I think maybe the Fed will hike rates 2 more times, and maybe the yield curve would shift a little, maybe become a little steeper, or maybe it'll become a little flatter, whatever the outcome view was. So that was sort of the larger, bigger picture, macro view, one view that I formed. Okay, is there a trade to be done out there? So you take that view, and this is where the world is today. This is where I will expect the world to be 6 months from now. What is the market pricing in 6 months from now? You go to the futures markets, you go to the options market, and you scan, you use screens and analytical tools to figure out, okay, if I'm right about my view, what is the market pricing in? If there is a discrepancy between my view of the world and what the market is pricing in, then perhaps there is an opportunity to create a trade, because my view disagrees with what the market prices are. And if I'm right, I'm going to make some money. If I'm wrong, I'm going to lose some money. So now we got a trading view, a trade idea in its early stages, infancy of perhaps there is a trade to be done. All right, so further research, and we will come to how do we best structure this trade. Okay, if I were to bet on 6 months from now, short-term rates would be 50 basis points higher, and the market is only pricing and they'll be higher by 25 basis points. So that 25 basis point, if I'm right, profit that I could possibly make, what structure do I utilize? What instruments do I utilize to create a trade where if I'm right about my view, that I can beat the market by 25 basis points? I don't want to lose too much money in case I'm wrong. So we look at the futures markets, we look at the futures spreads, we look at options on futures, and see where we're going to get the most bang for our buck. And then we start tinkering around and see, okay, maybe it's an options trade. Maybe we buy put spread on Eurodollars, or maybe we do a spread trade on Eurodollar futures, where we we buy the near-term futures contract and sell the further out futures contract, calendar spreads. But it's always looking to see if there is a way to structure your trade and minimize the risk. It's what I call an asymmetric risk payoff. That if I'm right, I'm going to make money. If I'm wrong, hopefully I'm not going to lose as much if I were to be long or short outright. All right, so that is what we're trying to do. Again, it all falls into the big picture thinking of the trading process. So now we've found a trading view, we found a trade idea, and hopefully we put a structure of a trade around it. Right, so far so good. Okay, when are we going to pull the trigger and initiate the trade? Not so fast. Think about how much risk are we going to take? If we have a total capital of, let's say, $100, how much of the $100 are we willing to risk on this one trade? So position sizing becomes very important.
Right.
And perhaps we want to risk only 5% of our risk capital on this one position. All right. So how do we get the most bang for a buck with that 5%? Maybe you leverage up with some options. Futures markets give us more leverage, or which are also liquidity comes into play. We always want to be in the most liquid instruments.
Just wondering, why do you say that? Why do you want to be in the most liquid instruments?
Because if liquidity freezes up in the markets, you may get into a trade, you may find it difficult to get out. So I've always tended to favor liquid markets, unless by choice the rewards are so huge in some asset classes where you choose to take that risk, maybe distressed debt or something like that, which is at times can be very liquid. But liquid markets, liquid instruments are always on the preferred side of our risk management metrics. It's like to say, make sure when you get into a trade that you can also get out without too much pain. So if you're wrong about things and you need to exit, there should be enough liquidity out there for you to do it. For smaller traders, probably it's not a big issue. Most products that trade on exchange are liquid, but for large-sized positions, it can be a problem. Did I answer your question, Michael?
Yeah, and I think that's also important to identify as well, and it gets back into what you were mentioning before as well. If you're day trading and there's a liquid opportunity, sometimes they have better opportunities in terms of risk reward. But if it's a day trade, you can get out. But if it's a longer term holding, maybe a less liquid contract is something that does have more danger because you're not sure if you can get out, things like that.
Sure. But so far, we've covered, the plan, how we get to the actual trade. So now it's position sizing. It again comes down to having a plan at the very outset of starting a trading business. How much capital are we willing to risk on a single position? And there we have to be very disciplined. Because it's very easy in the heat of the moment when we feel that we have a very high conviction level on a certain trade or position, to bet more than we would prudently bet on that one position. It's very easy to get swayed and then regret at leisure afterwards when things don't work out as well and say, oh God, why did I put 20% of my risk capital in one position when I had a limit of 5%? So it's important to size the position appropriately. Excuse me. And, another thing that I've found that's very helpful in this trading process before we initiate a trade is look at the trade from the other side. So let's say if we want to go long a position. Look at every possibility. We made a case for ourselves why we want to be long. That's obvious. But try and imagine what the world looks like from the other side of the trade. What if you wanted to go short that? What this exercise I found often does is it highlights or sometimes brings out into the open some of the risk to the trade that we may not have seen through our rose-tinted glasses before. It's a great exercise. You know, it doesn't cost anything to examine the trade from the other side, but it often has helped me, at least not to initiate a position that I initially thought was great, because I saw a certain risk and I saw how things could go wrong and why they could go wrong when I looked at the same position. Also, it's important even before we initiate the trade is to have a plan. How we are going to manage the position once we pull the trigger. You know, there's an old joke on Wall Street that any monkey can pull the trigger. That's not our part. The tough part is managing the position on an ongoing basis. I'm not talking about day traders. I'm talking more about longer term trades. You know, how do we, if we want to hedge the position, how do we hedge the position? If we want to add to it, or if we want to take some off, when and how, under what conditions. So we need to have a plan. Analogy I will use is, for those in the audience who may be familiar with the game of poker, if they've ever played poker, is before you even play a hand, have a plan what you're going to do with that hand, because there's always going to be incomplete and uncertain information about that hand. You don't know what cards your opponents are holding. You don't know what actions your opponents are going to take on the table. If you get raised or if you get called, or how are you going to act? What are you going to do? One's got to have a plan. Similar to that game of poker, when one initiates a position. Are we going to stick with that position if it goes against us? Or are we going to fold? Are we going to have a disciplined stop loss limit? Or are we just going to go along for the ride and see what happens? Whatever you choose to do, but there's got to be a plan well in advance of initiating the position. Because once the position has been initiated, then then we don't want hope setting in. That, you know, and that's where traders get into a lot of trouble, is initiate a trade with all great convictions and all great hopes, and it starts going against them. And sometimes they freeze when they should just exit the position. Sometimes they double up when they should not. Sometimes they just like deer in the headlights and don't do anything. They're unable to take any action. And that's where problems begin. We don't want to have this problem. That's why we need a trading plan. We need a plan, we need a discipline, we need an approach that is natural to us and fosters discipline, practice each and every day we sit on our trading desk. So that, in a nutshell, is my take on why every trader needs to have a trading process and what some of the essential elements of that trading process ought to be. I'll throw it up for discussion and questions.
Yeah, no, that makes a lot of sense. Everything you just said, very interesting, valuable information, you know, as a trader, you know, thinking about the markets, thinking about their process. I guess following up on one of your comments about the asymmetric risk, asymmetric tail risk that you look for, you know, how do you find that best structured? Is that something, you know, utilizing options, stops, or is it just up to the individual traders what they're comfortable with?
You know, asymmetric risk by definition can only be found in options and option-like structures. Maybe they're explicit options, or maybe they're sort of embedded options. By explicit options, I mean when you are actually structuring a trade utilizing options. You know, if you long, let's say, a stock, and you buy a put on the same instrument or some indices, you know, you are creating a sort of a hedge. I don't know how well it may be correlated, but you're creating a hedge from severe downside in the time frame that you're holding the position, right? Or you could structure a trade entirely comprised of options, right? You expect the market to go up, so now you long a delta, and you buy calls or whatever it is, or call spreads, and so you limit your risk. You know what the premium you paid for it. That's your max amount of downside that you will lose. But just there are businesses out there that make a living out of selling premiums, so they're thriving as well. So you got to be sure that those premiums are not wasted. So there's got to be a very high conviction rate if you're going to bet with options, and how far.
What do you tell? I'm sorry to interrupt. What do you tell those? You just brought it up. So what do you tell those strategies, those guys that are selling out of the money options consistently and make money 96% of the time? They make a small amount of money, but those 3 or 4% of the time when they lose money, they just get steamrolled. They get crushed. So as a trading coach, what's your advice to them?
My advice is look at the risks of your business, look at the risk of your business plan, and figure out for yourself if the strategy makes sense. Now, I have a lot of respect for strategies and people who make a living by being short wall and just selling options, because it's a regular, easy way to sort of take in premiums.
Right.
Once in a while, depending on the asset class and depending on how much risk they're taking, every once in a while, there's some market eruption or volcano erupt somewhere, and these guys get caught and they're out of business. So that is the downside. I don't advocate either strategy. I don't advocate that you become a short wall seller. I don't advocate that you become just a long only premium people. But these are instruments that are out there. Utilize them to the best of your ability, for the best of your portfolio, for the best of your risk management style. But these options have certain attributes. There's built-in leverage, and it's a sharp knife. It cuts both ways. So it wasn't designed to kill humans or kill institutions, but it happens time and time again. It's all about risk management. So choose the strategies and choose your instruments very carefully, and be disciplined about it. Personally, I have always advocated an asymmetric risk profile in my favor, which would not include selling outright options, naked options. I've never sold a naked option outright. I would do it in spreads. I would do it perhaps in other ways, but never have exposure where the gain is limited, but the loss is potentially unlimited. Never want to put myself in that.
30-cent gain for $30 loss at times.
Yeah. I have never advocated those strategies. I never will.
Yeah, it's interesting because a lot of people do, and in February this year was that example of a lot of guys that clip look for those 10, 20, 30-cent gains, but in February some of those options literally went to $30, $40, and they were forced out of positions at levels. So you make money, you make 30 cents for month after month after month, and then when you're kicked out at $30, that more than takes out those sort of small gains that you've been acquiring.
You're absolutely correct, Michael. I know exactly the situation they're referring to. As a coach, as a personal preference, I would always recommend defined limited risk, where the payoff is multiples of the risk undertaken, as opposed to defined limited gain versus unlimited risk. I want to make that very clear, especially if there are some traders who are just starting out in the trading world, who are new to the world of trading. it may behoove them to study the history of trades gone wrong and understand the math behind limited gains and unlimited risk.
Yeah,
And vice.
that makes sense. Also, like you said, studying some of the old history books and hearing some of the good stories and some of the tragic stories as well. I guess, what do you take from, it's the end of the week. You joined us last Friday. You're joining us this Friday. What do you you're talking about process before. What do you think you would want to tell a trader who just had a fantastic week, better than expected or better than usual? He's riding high into the weekend. What would you tell him about his process and what kind of the mindset should be after having a fantastic week?
Yeah, that is a great question. If I may, I would extend that from just having a great week to, let's say, having a great career. If the trader's had a great week, the first thing I would say is the trader should examine the week and see why his week was so great. Was it skill? Was it good risk management? Was it good trade identification? Was it good trade structures? Or was it also partly luck? All right. And was it the trader's skill that helped him make that money? I mean, it's a big distinction. Sometimes when we have a lot of success, it can make us feel invincible. I've observed that in a trader's life, there are three stages of a trader's career. First, the early stages. Let's say if we break it down to 3 decades, a 30-year lifespan of a trader, which is long, by the way. There are very few traders I know who've been in business for 30 years, but there are quite a few. The first 10 years are probably a learning process. Trader comes in as an intern or assistant on a trading desk, and they spend a few years with a senior trader. As they go for learning the markets, learning the instruments, record keeping, watching the screens, and sort of doing some hedging, risk management, whatever, till they grow some skills. A couple of years later, now they're given some risk limits and some capital to trade a little on their own. They start trading, and they usually have a role model out there. Some trader, some senior trader, or some trading style that they try to emulate and grow into, and they have some success. And now they're making some money, and a couple of years go by, they grow in their career. Now they're becoming more comfortable, and they're given bigger risk limits now, more capital. And then they have a few big home runs, like this week that you mentioned. You had a great week. And all of a sudden, we get that godlike complex that, man, I am smart. I'm a genius. Jesus, I'm making so much money. And the typical trader stereotype egos, the big swinging dick ego, starts going in. And that is a dangerous state. Because now we're getting more and more capital at our disposal. We're having a lot of success. Hitting a lot of home runs, making a lot of money. Everybody holds us in awe, and hubris begins to set in. Very dangerous state. And then inevitably, something goes wrong. A big trade blows up, you lose a lot of money. Perhaps the trader doubles up, loses more money. Then there are calls, maybe the trader gets fired, loses his job. Finds another job as a trader somewhere else, has very little success, blows up again. A couple of years, 3 years, few years go by, and all of a sudden, his psyche is in shambles. He needs to build that confidence back. A lot of traders at this stage of the game, they basically quit trading and move on to something. Those who still have the energy and the strength to sustain themselves come back. And now begins to appear humility. They learn from the mistakes, they look back and say, it wasn't really my skill. There were other factors that contributed to my success. Maybe I was on a big flow desk. I saw all the flows that helped me. Maybe I got lucky. Maybe, I made a couple of big bets and I just simply got lucky. Those weren't smart bets, but the outcomes were good. So there's a big difference between making good decisions that have bad outcomes or making bad decisions that have good outcomes.
Right.
The trading world presents us with both. But it's that final period, like the third decade, humility. And that is where, if traders last that long, they become really good traders. Because they've seen periods of great success, they've seen periods where they made big mistakes, they've been fired from a couple of jobs, they found humility, they analyzed their own thinking, and they came back much stronger and much smarter as risk managers and traders and say, you know what, I didn't know much back then. So, in a long-winded way, to answer what I tell a trader who's had a great success this week is, pat yourself on the back, take the success in stride, but be humble about it and analyze how you got that success. How much of it was skill and how much of it was luck. Yeah.
Yeah, that makes
That's a good way of thinking to move forward in their trading career.
yeah, that makes sense. What about, people always say when you're not trading well to trade smaller, but what about in the other way around when things are going well? Do you advise or do you talk to your clients about when things are going well to trade bigger and trade more, or just, what do you tell them when things are going well?
I wouldn't look at when things are going bad or things are going well. I would look at another way. Hey, if you see an opportunity, a trade opportunity, that makes sense, that for all the rationale that you use in analyzing trading opportunity is compelling, where the risk rewards are compelling, go for it. It has nothing to do with whether you're trading well or whether you've been trading poorly. All the more reason, if you've been trading poorly, to build your confidence back. All right, if you have a really good trade opportunity as objectively as you can look at it, go ahead, put on that trade. Don't let a few losses or a few falls deter you. That is the emotional strength of great traders. I mean, you ask guys like David Tepper or Stan Druckenmiller, how many times have they had losing trades? They've had their heads bashed in, but the very next day they put on another large trade because they found an opportunity. Or even better, these same guys, the really good traders, they go months without doing a trade. Sometimes, if they don't see an opportunity, there's nothing to do. Go play golf or go on a vacation or read a book. Do nothing. But somehow, most traders, correct me if I'm wrong, have a tendency, just because they sit in front of the screen at 8 o'clock in the morning, they feel compelled that they have to be involved in the market. The real smart ones don't.
Yeah, Mark Fisher was just on with us before, and he's repeated this a number of times that exactly that. Sometimes you just got to sit on your hands and do absolutely nothing.
Yeah. Always wait for the right trade.
Yeah, you talk about the process before, even when, regardless, things are going good, things are going bad, let's focus more on the negative. This week, as an example, the guy who bought dollar turkey on Sunday night at 7.15 and it's 20% lower now, bought gold and it's, a few percent lower, been long Bitcoin for a while, and to throw it on top, he's been long Tesla. So the quadruple whammy of everything. What do you tell him going into the weekend for the new week, looking at next week?
Well, I would say look at your trading process and ask yourself, each one of those trades, how did you rationalize those trades? What was compelling about it? Take Tesla, for example. Did you go long Tesla in a strong belief that the company is going to go private? Why did you think so? Why did you believe so? Was there enough evidence? Did you really think it was a high percentage trade over the risk of the trade going wrong? Did you look at everything? Or do you just get carried away by the momentum of the moment and say, okay, this is the trade du jour, everybody's doing it, so I need to get on board? Or the fear of missing out? Or was there a real, thoughtful analysis the trades that he got into. I mean, whether a trade has been successful or not, I would advise every trader to look at the outcomes of each trade that they do, just to examine their own decision-making process.
So it sounds like whether good, whether bad, you just got to focus on the fact of why you are doing what you're doing, how successful you've been in the past, put the last trade behind you, and it sounds like you don't advocate really, even when trades are going well, to continue to trade larger. Everything is just the process. Get back to unit one and look at the market, every trade, brand new trade.
Michael, I would say trade within your comfort zone and your natural state. Now, just because we've had success recently doesn't mean automatically that we are comfortable or fit enough to trade a larger position size. All right? I don't find any mathematical rational justification. I would say trade the size that you're comfortable with, the risk that you're comfortable with. Trade discipline. All of a sudden, you may be trading very well, and now you've put on a humongous, gigantic position. Does it make you sleep well at night? If the answer is no, no. Is it possible that in that one trade goes wrong, you could lose all that you made in the last 1 week and all the dozen other trades that you did? How much risk are you taking? It's discipline again. It's when people lose their discipline is when they get into trouble. Are you betting the whole shop on that one trade? Or are you still saying, hey, this is my position size limit that I define for myself. Never more than 5% of my risk capital am I going to put in any one position. Am I still within those parameters? Fine.
Yeah, no, that makes a lot of sense. What other sort of topics, last week you spoke to us about edge, today you spoke to us about process. What other sort of topics do you typically kind of on a schedule kind of talk with your clients about?
A topic that is very few traders openly like to talk about, but it is perhaps at the core of trading, is our emotional state, our emotional well-being. It's easy to pay lip service and say, nah, I keep my emotions within control. I don't get distracted. I don't get overpowered by emotion. And that is so much baloney. We are human beings. And as long as machines are not doing 100% of our trading and risk management, we are impacted by the fluctuation of our P&Ls and how well our trades are going or not going. So that is a large part of my coaching traders, is keeping their emotional sanity intact so that they can, at all times, or most of the time, think with clarity and objectivity. And there are many techniques that we use. It's a very holistic process. But that is something I'd like to talk about briefly in the next webinar, is emotional control, controlling our emotions.
Yeah, I think that makes a lot of sense. That'll be interesting.
It doesn't mean that we totally detach ourselves emotionally, because that is not humanly possible. But it does mean that we can manage and control our emotions. And to the extent that we're able to accomplish that, it'll help us in our trading. Or, it doesn't just limit, it's not limited to trading only. It can apply to all different professions, occupations. It's a very, very important element who we are and how well we perform.
What do you, on a bit of a tangent here, we just had somebody on before talking about blockchain and cryptocurrencies and was talking about it. That's been an interesting phenomenon, especially over the last probably, let's call it 12 months. We've seen a significant rise, and now we've seen a big fall. What do you tell the people that got caught up in it? Because you talk about edge, you talk about process. Nobody really has an edge in crypto, or especially over the last number of months. Nobody really had much of an edge. People were just buying into the idea of it, or what their neighbor was telling them, things of that nature. But now all of a sudden they're caught up in it. They bought it at 14,000. Or they bought Ripple, significantly higher than here. But let's just say, Bitcoin, they bought it at 13,000, 14,000, something like that. Now here we are at 6,000. What do you tell them, the guys that might have had a discipline in certain markets but got caught up in this craze? What are your thoughts here now that we are significantly lower and months later?
It's not what I would tell them. It's what I would ask them. I said, what rationale did you use to invest in, let's say, a cryptocurrency? What was your rationale?
I'll tell you, the rationale was fear of missing out.
Okay, so, and you are probably right on the money on that. So, is fear of missing out a rationale for trading assets or trading your capital? I've heard, or is there a better rationale? I mean, I've heard people say, you know what, okay, I put X amount of money in Bitcoin, and I knew if it goes to zero, I'm okay with it. All right, that's a rationale. But beyond that, so you limited your risk by saying, okay, I'm going to invest X dollars in Bitcoin. If it goes to zero, I'm okay with it. But it was fear of missing out that said, this thing could go to the moon, and all of a sudden, it'll be worth 100,000, it'll be worth $500,000, like some proclamations I've seen out there. There's fear of missing out. You're right. But what else? I mean, if we talk about professional traders here. We're building a trading business. We're running a trading business. Hope or fear of missing out are not elements of the trading business. I would dare suggest that. No. Those are not elements of a trading strategy or a trading business.
So you'd say really sticking to the key points of trade what you know, invest in what you know, and I guess, or the other way of looking at it is be able to invest in a number that, like you said, you're okay with it going to zero and be done with it and just put it in the account and don't look at it.
No, I don't recommend that. Be okay with going to zero and putting an account. Don't look at it. No, I would not recommend that strategy. To me, is read what you know, what you said, and know your assets, know your instruments, know your risk. And there always has to be a rationale behind why we take any action.
I know a lot of smart traders who got involved in Bitcoin in the 10,000, 11,000, 12,000, even 9,000 sort of range that got in for fear of missing out, of saying, okay, if this thing actually does go to 50,000 or 100,000, the amount of people that will surpass me in wealth sort of thing, that sort of mindset. And so I have to be involved to some degree.
Well, those traders need a lot of coaching. I mean, if the primary rationale for doing a trade is the fear of some of the peers surpassing their wealth, that to me is not a very logical way of looking at the market for a living.
I'm going to copy, I'm just going to take that little clip and send it to a few of my friends.
Yeah. And it's, as Warren Buffett famously has proclaimed that, the three rules of trading or investing are don't lose money. Rule number 2 is look at rule number 1, don't lose money. And rule number 3 is look at the 2 rules above you, don't lose money. There has to be risk management, there has to be a rationale.
Yeah, that's.
I personally, I don't have a view on cryptocurrencies. The blockchain technology seems to be very promising. It probably has is going to transform this planet as we know it. I personally have looked into certain aspects of the blockchain business and cryptocurrency businesses. To be quite candid, I've looked into a business of lending against cryptocurrencies, but there are risks to that business, and I've identified those risks, and I'm trying to find ways to solve how to manage that risk. If I cannot manage those risks, I will not launch that business. But those are real risks, and the risks are, if the value of cryptocurrencies declines dramatically, or there's a lack of liquidity in some of the currencies, then the lender is in trouble. Storage of custody, cryptocurrencies, and other big real world problem that still needs to be solved at an institutional level. So, we shouldn't be averse to looking at new opportunities and new ideas, but as we analyze them, there has to be solid analysis and rationalization as opposed to just hope or fear of missing out.
Yeah.
It's an interesting discussion, though.
Yeah, absolutely. And it was interesting tangent because we just had somebody on before, and I agree with you. It's interesting technology, and it's a fascinating story that everybody's watching closely. So, once again, another great conversation, Rajan. Last week you took us through Market Edge. This week you took us through Process and a lot of other topics as well to go along with that. And so thanks a lot for joining us and giving us that great information, and we look forward to hearing from you again.
Thank you so much, Michael, for the opportunity. And next Friday, we'll talk about emotions and emotional control and how they impact our trading activity.
Sounds good. All right. Well, have a great weekend. Thanks for the help.
Okay.